$310 million. That number never existed, and for a while nobody noticed. This is the story of Luckin Coffee, a Chinese startup that built one of the fastest-growing coffee chains in history, went public on the NASDAQ, and then admitted it had fabricated roughly $310 million in sales. It is a story about ambition, pressure, and how easily a number on a spreadsheet can become a lie that swallows a company whole. Welcome to the Autopsy. Luckin Coffee was founded in 2017 in Beijing. From the outside, it looked like a genuine challenger to Starbucks in China. The company operated on a tech-first model. No cash, no counter queues, everything through a mobile app. You ordered on your phone, picked up your coffee, walked out. It was fast, modern, and genuinely popular. Luckin subsidized its drinks heavily, offering coupons and discounts to pull customers in. The stores were small, efficient, low-rent kiosks tucked inside office buildings and universities. By 2018, the company had opened more than 2,000 locations. By early 2019, it had more than 500. The growth was staggering, and that was exactly the point. In May 2019, Luckin Coffee listed on the NASDAQ stock exchange, raising roughly $645 million in its initial public offering. American investors, institutional funds, and ordinary retail traders bought in. The story was simple and compelling. China has won. 4 billion people, coffee consumption is rising, and this company is growing faster than any coffee brand in history. The stock climbed. By January 2020, Luckin's market capitalization had crossed $12 billion. Then a short seller appeared. In January 2020, a research firm called Muddy Waters received an anonymous 89-page report. The document alleged that Luckin Coffee was systematically fabricating its sales figures, inflating the number of items sold per store per day, and inventing revenue that did not exist. Muddy Waters published the report and took a short position, meaning they stood to profit if the stock fell. Luckin denied everything. The company called the report misleading and based on flawed methodology. The stock dipped, recovered, and life appeared to go on. But inside the company, the truth was already collapsing. In April 2020, Luckin Coffee's own board announced that an internal investigation had found that its chief operating officer, Jian Liu, and several employees had allegedly fabricated approximately $310 million in sales during 2019. The announcement landed like a demolition charge. The stock lost roughly 80% of its value in a single day. One of the sharpest single-session collapses in the history of a major listed company. To understand how $310 million disappears into a spreadsheet, you need to understand the mechanism. Luckin's business model made fabrication unusually easy to hide. Because every transaction ran through the app, the company controlled the data entirely. There were no third-party point-of-sale systems, no independent receipts, no cash drawer to count. If someone inside the company wanted to invent a sale, they could create a digital transaction record with no physical trace. The alleged scheme worked roughly like this. The company would record sales that did not occur, phantom orders from real-looking accounts. To move the invented revenue through the books in a way that appeared legitimate, cash had to flow somewhere. The company allegedly funneled money through a web of affiliated entities and coupon programs, creating the appearance of customer spending. Advertising and promotional expenses were inflated simultaneously, which partly masked the gap between real cash and invented sales. The result was a set of financial statements that showed explosive, profitable-looking growth when the underlying economics were far weaker. Institutional investors, analysts, and auditors were looking at numbers that described a business that did not fully exist. The auditor, Ernst & Young, flagged concerns, but the full scale of the fraud only emerged through the internal investigation. The board commissioned after the Muddy Waters report refused to disappear. The unraveling moved quickly once it started. In May 2020, the NASDAQ suspended trading in Luckin shares and initiated delisting proceedings. In June 2020, the company filed for Chapter 15 bankruptcy protection in the United States, a legal mechanism that recognizes foreign insolvency proceedings in American courts. In China, regulators opened their own investigations. The Chinese securities regulator fined Luckin Coffee and several of its executives. Jian Liu, the COO identified by the internal investigation, was among those sanctioned. The company's chairman at the time, Charles Liu, also faced regulatory scrutiny. In December 2020, the U.S. Securities and Exchange Commission announced a settlement. Luckin Coffee agreed to pay $180 million to resolve charges that it had defrauded investors by fabricating the roughly $310 million in revenue. The company neither admitted nor denied the SEC's findings as part of the settlement, which is standard practice in SEC civil resolutions. But the payment stood as one of the largest enforcement actions involving a Chinese company listed in the United States. The $180 million settlement was painful, but for investors who bought shares near the peak, it was cold comfort. At its high, Luckin stock traded above $50 per share. After the collapse, it traded in pennies. Billions of dollars in market value had evaporated. Pension funds, mutual funds, and individual investors absorbed losses that the settlement did not come close to covering. There is one detail worth sitting with. Luckin Coffee did not go out of business. The company restructured under Chinese insolvency proceedings, replaced its leadership, settled with creditors, and eventually resumed trading on the over-the-counter market in the United States under new management. By some accounts, the actual underlying coffee business, the real stores, the real customers, the real cups of coffee, continued to function and even grow after the fraud was stripped away. That is almost the strangest part of the story. Beneath the fabricated $310 million, there was a real company doing real business. The fraud was not built on nothing. It was built on something genuine, stretched and distorted until it became a lie. That is often how these things work. The kernel of truth is what makes the deception convincing. If Luckin had been a pure fiction, a warehouse full of air, it would have collapsed much faster. The real stores, the real app, the real lines of customers gave the invented numbers somewhere to hide. So what does this autopsy teach us? It teaches us that the velocity of growth is itself a warning signal. Any company growing faster than its industry, its competitors, and the laws of economics can comfortably explain deserves a second look. It teaches us that when a company controls all of its own transaction data with no independent verification, the risk of manipulation is structural, not hypothetical. And it teaches us something uncomfortable about markets. That for months after the Muddy Waters report was published, with the allegations sitting in plain view, the stock recovered and investors kept buying. Because the story was good. Because the numbers were exciting. Because people wanted it to be true. Money does not die because of complexity. It dies because of belief in a number, a story, a chart going up and to the right. $310 million that never existed convinced enough people for long enough to move billions of real ones. The coffee was real. The company was real. The number was not. And by the time the difference became undeniable, the money was already gone.